We are joined by an important market voice, Rashesh Shah, Chairman and CEO of Edelweiss Group and President FICCI, to talk more about how the RBI and the government can work together to really check this problem. Rashesh, it's great to have you on the show. Thanks very much for taking out the time. First up, what is your expectation from the board meet?
Good morning. I think there are 4 or 5 issues that have been flagged off in the past, and I think they obviously, different points of view, but I'm hoping that at least if not agreement, they can start some process of forming some committees and all. As you said, liquidity in the economy is very tight, especially MSMEs and all are still struggling. Last 3 years, the credit availability to MSME has been steadily going down. So we need to address that. And as you know, fortunately, inflation has come down. So holding high interest rates and holding very tight liquidity is no longer required because inflation fears have abated. So I think that plus the PCA, framework for those 11 banks, and there are quite a few issues out there. So I'm actually pretty sure some action will get initiated.
Hi, Mr. Shah. This is Mubina as well joining into the conversation. So let's address some of those topics that are expected to be discussed. A lot of bankers and a lot of people we've interacted with, over the last 2-3 days have stated that PCA norms would perhaps be looked at a case-to-case basis, and they definitely do need some relaxation. So if this does come through, if the relaxation does come through, do you expect this better credit growth for the industry, for NBFCs?
Yes, absolutely. And you should remember that NBFC is also providing credit to a large part of the economy. So the more credit that flows to NBFCs, they also onward will flow it out to the economy. And, banks have cleaned up a lot of their NPAs. The provisioning cycle is almost coming to an end. And fortunately, we are at a stage that industrial investment demand is starting to come back. But along with that, consumption is slowing down because of high oil prices in the last quarter, but also high interest rates and very tight liquidity. Consumption is slowing down, and as you know, consumption has been the real engine for India's growth. So I think if we can ease off liquidity, make sure credit flow remains stronger. After many years, for the first half of this year, total system credit grew more than 14%. And 14 is not very large amount, but for the first time it has crossed 14%. We should make sure that we at least have about 15 to 16% credit growth in the system to maintain the investment demand, which is just starting to come out, but also revive the consumption demand, which has been the mainstay of Indian economy.
Yeah. Having yourself had an NBFC arm, Rashesh, what is the assessment that you have made of the liquidity situation for NBFCs, and how much can the RBI do in addition to what they've already done with regards to checking that?
So I think overall the NBFC liquidity situation has improved quite a bit. I think 8 weeks ago there was almost like a crisis of confidence and things had frozen. Mainly, as a result of ILFS, which was not truly an NBFC, but since it was classified as an NBFC, there was this whole, crisis of confidence, which seems to have passed. The liquidity for NBFCs is coming back to normal. Commercial papers are happening, bonds are happening. So I don't think it is specifically providing liquidity to NBFCs that is currently a big issue. But the problem is that overall liquidity in the system is still very tight. There are a lot of deposits that are flowing to banks because after this crisis of confidence, a lot of funds came out of mutual funds and went to banks. Now, a lot of that are, under PCA banks, so unless they can lend aggressively, a lot of liquidity is getting stuck. So there is good amount of liquidity, but the flow of credit is not starting. So we need to differentiate between the two. Just overall liquidity is not important. When liquidity results in flow of credit, that is very important. And currently credit flow is still very constrained. And RBI needs to, increase liquidity a little bit, but also look at the risk weightages for MSME credit, some more incentives for housing loans and others, so that we can kickstart this, the frozen part of the credit flow that is there. So I think we should stop talking about only liquidity, but we should start talking about credit flow.
Okay, interesting. Not just liquidity, but also ensuring credit flow. That is something that Mr. Shah would be looking out for. You had recently mentioned that the NBFC regulatory framework needs to be looked at. You mentioned a couple of points in passing as well, just in your previous answer. So, apart from that, what are the other changes you propose or you'd hope the RBI would take?
See, RBI, needs to revisit the NBFC framework, because I think the last time this framework was structured was about 10-12 years ago. At that time, NBFCs is a very small part of the overall credit flow. Now, as you know, NBFCs have, they have become almost 30% of the incremental credit flow. They are almost 22% of the outstanding credit in the economy. But more importantly, for various parts like consumer durables, like home loans, like MSME credit, NBFCs are playing a much larger part in terms of delivering credit for all this. So given that, we need to look at the framework both on the risk weightages for NBFC, on the liability framework for NBFCs. And when we call NBFCs, we use them loosely, but there are many kinds of NBFCs. There are housing finance companies, there are asset financing companies, there are microfinance companies, there are retail NBFCs. So I think there is a need for a comprehensive framework. There is a need to make sure that the liquidity crisis in NBFC does not occur. Fortunately, 8 weeks have gone. The NBFC industry has done very well. There has been no accident, not a single after ILFS default. There has been not even one small NBFC that has defaulted, which shows how strong the industry already is. But I think a framework around this, also ensuring that NBFCs don't use that for industrial investments, because we don't want NBFCs to be a conduit for industrial investments, because that is what happened effectively in ILFS, because a lot of the NBFC money was invested in infrastructure projects. So I think those are the rules we need to revisit, and we need to make sure that there is a robust framework for NBFCs which allows them to grow, and they complement the banking system. The banks and the NBFCs are two main providers of credit for the economy.
Rashesh, the other point of discussion today will be on RBI reserves. While it is true that RBI has fairly high reserves at 30%, Chris Wood this morning, who needs an introduction, noted India name, India investor, also mentions that it is likely that the RBI should help, channelize some of those reserves to the government, if that is meant for the purpose of recapitalization of PSU banks, and also help in the evolving lending culture that we are witnessing right now. He's compared the balance sheet of the RBI to that of the Federal Reserve, and says that some checks and balances can be put in place. Do you think that that may happen? Rashesh?
Yeah, I think overall we need to have some framework on Hello?
Yes, please continue. I thought you were not getting my voice. Please continue with your answer.
No. Yeah. So what I was saying is, yes, I think overall we need a framework for what should be the reserve policy for RBI reserves, and that also impacts what is the annual dividend they pay to the government, because RBI dividend is also an important source for the government. Like any shareholder expects some, dividend payout. So I think overall we need a framework. I think it's a very technocratic exercise we need to do, and for the reserve conversation, I think it is high time we move away from a very dogmatic approach that either this is right or that is right. Form a panel of experts. There are global experts, there are Indian experts. This is something that you can arrive at by applying a lot of rules and principles to see how other central banks have approached the reserve issue, because there are many models available. India obviously is a unique country by itself, but we need our own framework which is clearly articulated and which is clearly structured, so that going forward for many years, what reserves RBI should hold should be very clear. That will also be good for investors, global investors, because once they know, then any episode like this where suddenly people feel that government is, taking away reserves of RBI, which is not the fact, but what government is saying is, let's create a framework, let's create a approach to say what is the adequate, the minimum and the maximum amount of reserves RBI needs to hold, RBI should hold, to make sure that they can provide financial stability to the country.
All right. Okay. Great, Mr. Shah. Thanks so much for joining in on ET Now. It was great to get in your perspective. A whole host of issues, not just liquidity, but even credit flow is important, like Mr. Shah did flag off. And of course, NBFC framework important to address that as well, because banks and NBFCs are the two key credit providers for the country. A very interesting perspective over there.